Okay, our subject here we're going to cover today and on Tuesday is a very important one, is the issues of making decisions based on costs. I said one of the most important objectives of cost analysis and cost management is to provide support for decisions. So we come to a time where we want to review the more important business decisions that are based on cost analysis and cost management and how those decisions are made. So we'll start with a very important set of decisions that we'll refer to as pricing decisions. And I think the reason why they are important is self-explanatory. It's important when you are in business to price, to decide how you price the products that you sell or the services that you render. And pricing decisions, the right pricing decisions and how to make them are therefore very important. So we're going to go over a number of methods that are used to make pricing decisions. And we're going to base our examples on the car rental case or car rental illustration that we discussed. We're going to use the same numbers because we're already familiar with the numbers, so we can save time in terms of not introducing new numbers. So just to remind you of the numbers, well, first of all, let's say that the first method that we're going to review, pricing method, is known as the fully allocated cost plus pricing, or cost plus pricing based on fully allocated costs. Now, this is fairly simple conceptually. It's a fairly simple method. And the name really tells you all about it. You start with the costs, all the costs, which are fully allocated to the product or the service that you price. And that, of course, will include all the direct costs, indirect costs, variable costs, fixed costs. And you sum up all these costs per unit, all those unit costs, and you get a total fully allocated cost per unit. And to this total fully allocated cost per unit, you add a target markup or a profit margin. That is the profit margin that is deemed desirable and feasible by the business. And after adding this markup or profit margin, you get to a targeted price. So let's see, let's go through the illustration and see how we work it out. Just as a reminder, the variable cost per car, remember in the car rental example, we are renting cars, we're selling car days. The direct variable costs, where economic car depreciation per car day was $10, maintenance per car day was $2. Then there were the indirect variable costs of selling an admin, $8 per car day. And then there were the fixed overhead, the leases of building and land, $11, and other allocated fixed costs were the costs of opportunity costs of tying up the funds to the purchase of the fleet of 100 cars, and that came out to $6 per car day. So if we add all those costs, 10 plus 2 plus 8 plus 11 plus 6, we get that the fully allocated costs are $37 per car day. Now the next thing, we have to decide what kind of a markup or profit margin or markup on costs we plan in terms of profits. And so we have to decide on what is desirable as a target but also feasible given market conditions. Now let's assume that we decide that this is 16% in this case. So we tag on another 16% to the fully allocated costs, or we multiply the $37 fully allocated cost per car day times 1.16, and we get $42.92 or $43. So the idea is, if we price at $43, we charge the customers $43, roughly $43 per day for the cars that we rent. And if indeed our costs are well estimated at fully allocated at 37, then we're going to make a profit per car day, a profit on a unit of 16%. So that's why it's called also the cost plus, because we take the fully allocated costs and the plus that comes on that is the markup or the profit target. So these are the mechanics. Now in most companies that use fully allocated, that we use cost plus, do it on a fully allocated cost. Some do it only on the variable costs. So the variable, if the variable costs in our example are $20, and here we need 115% markup to get to, if we want to get to 43, so it will be 150% markup on variable costs if you mark it up on variable cost rather than marking it up on fully allocated costs, which include the fixed cost as well. Okay, so these are the mechanics of the method, and you see the it's simple, and the simple calculation here is I want to price so that I fully cover all the costs when I sell the product or the service. We fully cover all the costs, and after fully covering all the cost, on top of it we realize a target profit. So that's the idea. Any questions about the mechanics? Okay, like any method that is very simple, there is a trade-off between simplicity and a good number of weaknesses. In order to make things very simple, you build in weaknesses into those methods. We encountered that before. And the two major weaknesses here is, first, that we did not directly and explicitly estimate the demand. We started with cost. We built things up on the basis of cost, but we didn't ask ourselves directly, what is the demand for the product? And that is a major weakness, because we know, okay, so let's assume we have our fully allocated cost at 37. We did a target of 16%. We can sell units. We can sell car days for $43. We can charge $43, and we can sell car days. But the critical question is how many car days we can sell, right? if we overpriced and we can sell only 20 car days a year, right? So that's not very good, right? So obviously, we are not in a position to determine how much we will charge, in this case $43, and at the same time also to determine how many units we'll sell. If we could do that, then we would have very few business problems. Then we would need not study business, right? We would just sell, we will charge sky-high prices and sell as many units as we can. And we're going to be in great shape. Obviously, we cannot do that because if we zero in on a price, then how many units we'll sell will be determined by the preferences of our customers, expressed through how many units they will demand for this price, how many car days our rental customers will demand. So in order to know that, we have to know much more about demand. So basically, just to illustrate the main problem of this method, we could illustrate it graphically. If we measure on the horizontal axis volume, in this case car days offered and sold. Does everybody see here the vertical axis? Okay. On the vertical axis, we measure dollars of price, the price we charge, and the cost per unit. Measure both of those on the vertical axis. So let's assume that we plan on selling 30,000 car days. And we use the fully allocated cost plus method. So we add up all the costs and we get to, in our example, the fully allocated costs, we get to $37. We tag on a 16% margin. And we get to roughly $43. But let's assume that all this is well and good, but let's assume that the demand function, let's just assume looks like this. Remember, the demand function tells us our customers' preferences at each price, what would be the quantity that they will demand. Well, it turns out that at a price of 43, they would demand only 25,000 car days. So under these conditions, yes, we can estimate the cost of 37, add tax 16%, and decide that we'll charge $43 per car day. But with these demand conditions, we are not going to sell 30,000 car days. We are going to find out that we're going to sell 25,000 car days. So if we insist on this price of 43 and this markup, we are going to sell only 25,000 car days. But under these demand conditions, if we insist that we want to sell 30,000 car days, okay, we can sell 30,000 car days, but how much we will have to charge? Much lower price, right? Let's assume 24, right? Which is below our cost per unit. So we can determine the price, but then the quantity will be that we can sell will be determined by demand, or we can determine the quantity and then the price will be determined by demand. But obviously we cannot determine on our own as a business both the price and the quantity. That's just too good to be true, right? Of course, we can use another example, a rosier example. Let's say the demand is high, so the demand is here. So in this case, by charging 43, we are not optimizing because we can sell 30,000 car days, we're underpricing, and the demand is such that we can charge a much higher price, say 50. So in this pricing method, we calculated our cost and tagged on 16%, and we decided that we want to be at point A, sell 30,000 car days at $43. But unless we know more about our demand, we have no guarantees that we can be there, that we can reach point A, right? We may be forced to point B, for example, or we may be forced to point C, right? Or things in between. So you could see that without directly and explicitly considering demand, and analyzing demand and estimating demand, we have no guarantees that we can reach our pricing objectives. The other weakness is that, of course, without considering demand, we don't optimize. We cannot decide what is the price that we can charge and how many car days we have to sell, say, if we want to maximize profits. We're not going to get an answer to this question using the fully allocated cost plus model for pricing. Okay, any questions or comments on cost plus pricing? Okay, in order to remedy that, well, still, cost plus pricing is simple and it's commonly used. And in many contracts, including if you do work for government contracts, they want prices based on cost plus. So in spite of the weaknesses, it is a method that is commonly used. To try to improve on this method and to give more consideration to market conditions, we have another method that is called target pricing, target costing. Now, in the target pricing, target costing method, unlike in the cost plus method, we don't start with a cost, but we start with the following question. what is a competitive price that we can charge for the car days that we sell in this particular market. So we don't start with cost, we start with market conditions. And we try to do market analysis and assess what is the price that we can charge. And let's assume in this example we come to the conclusion that given the competition in this particular market, the targeted price, the competitive price that we can charge is $40 per day that we rent. Then we ask ourselves, what is a desirable and feasible profit target? And let's assume we decide on $6 per car day. Well, if we want to be competitive with pricing at 40 and we want a profit of 6, then obviously our target costing should be 40 minus 6 or 34. Because otherwise, if we don't achieve a fully allocated cost per unit of 34, we will not be able to price in 40 and realize a profit of $6. So we subtract the 6 from 40 and we get a target costing of 34 that is consistent with a competitive price of 40 and a targeted profit of 6. Problem is that 34 target is below what we estimate our fully allocated cost to be. So there's a discrepancy. The target is below the kind of cost that we expect to incur. So what are our options at this point? We can either try to downward revision of the budgeted cost from 37 to approach 34 by figuring out cost-saving opportunities, how we can cost save to the extent of $3 per car day to go from 37 to 34. So it's either cost savings or efficiency improvement and cost savings through re-engineering and redesign processes. Or we could look at the price and say maybe the competitive price is 40, but if we add quality features, improve our quality, and can find a way to add unique quality features to our car rentals, maybe we could charge a premium price above $40 and still maybe we can charge 43, and then if we have to realize $37 of costs, but we can charge a premium of $3.43, we can still realize the price of 6. Or we can say, well, maybe the price of 6 target is too lofty or too ambitious, and we have to modify it. We just can't, we have to modify our profit aspirations here. So we have to reduce it. So that's basically how target pricing, target costing works. It's considered by a good number of people to be better than cost plus because it starts with assessing the market, the competitive price, and it gives you an incentive to consider options to modify your targets or to become more cost efficient. But of course, it still doesn't address the question of demand in the sense that it doesn't address how many units we are able to sell at 40. We have to know the demand to know how many units we have to sell at 40, and it doesn't broach the optimization issue. How much do we have to sell and how much we have to charge in order to maximize profits? So any questions about target pricing, target costing? Okay, so we complained that there is no consideration of demand and no optimization. So let's consider the incremental cost pricing optimization model. Now that's the model that you're familiar with, like you discussed in managerial economics, right? Question is how many units do we have to sell and how much do we have to charge if we want to maximize our profits. Okay, let's go over this here with this example. Obviously, the optimization model, as you know it, first thing you want to formulate your cost function. The function total cost as a function of the volume, the number of car days that you sell. Total cost denoted by TC, the number of car days, or the volume denoted by Y, by the letter Y. So then TC, well, total costs are, first of all, you bring in the fixed cost. The fixed costs are the $180,000 opportunity cost of tying in the funds to the car fleet by purchasing the cars, and the $385,000 leases for the building and the land. Those are the fixed costs. Then we sum up all the variable costs. Okay. Depreciation, $10 per car day times the number of car days, so 10Y. Maintenance, $2 per car day times the numbers of cars days. And selling and admin, $8 per car day times the number of car days sold. So then 180 plus 385 is 565,000, and 8Y plus 2Y plus 10Y is 20Y, so the total cost function is total cost equals 565,000 plus 20Y. Okay? Now the estimated demand function, we have to estimate the demand function, and one way to portray the demand function is quantity demanded Y, the number of car days demanded, as a function of the price per car day, which is denoted by P. And let's assume that the demand function was estimated, and the estimated demand function looks like this. Y equals 80,000 minus 1,333.33 P. So that's the estimated demand function. Now, you know that you can be shown the profit function is total cost, total revenues minus total cost. And you can set up the maximization by asking how many car days I have to sell to maximize profits. And the solution is obtained where marginal revenues, the additional revenues per car day, equal marginal costs. As you remember, these are the first order conditions for the profit maximization. So what we have to calculate here are the marginal costs and the marginal revenues, equate them to each other, and find the number of car days that will maximize the profits. Well, the marginal cost, as we all know by definition, mathematically is the first derivative of the total cost, DTC, with respect to volume, or the number of units, dy, so DTC dy. And if you look at the profit function and you differentiate it with respect to y, 565,000 becomes 0 and 20y becomes 20. So the marginal cost, or the cost for each additional unit of car days sold, is $20. Okay? Now I have to go over a number of steps to get the marginal revenue. First of all, we start with the demand function, and we rearrange the demand function. We just rearrange the terms rather than having the demand function in terms of y as a function of p. We have it as, we rearrange it to have it as a p as a function of y. So it's simply rearrangement. So if you go over a rearrangement of the terms, you would get that p, and you can check that, you'd get that p equals to 60 minus 0.00075 y. And we also know that p, the price is by definition average revenue, because the price that you get is the revenue that you get per unit, which means it's the average revenue. It's total revenue divided by the number of units. So price equals AR. AR stands for average revenue. So if average revenue equals price equals 60 minus 0.00075 y, to get to total revenue, we have to multiply the price by y. So we multiply the two sides of the equation by y. So P times y is Py, which is total revenue, TR. And we multiply the P here by y. So we get y, and instead of the P, we get the function 60 minus 0.0075 y. We open the parenthesis, and we get 60y minus 0.0075 y squared. So that's the total revenue function. Once we have the total revenue, we can get the marginal revenue by differentiating the total revenue with respect to y. That's what we do. We take the first derivative of total revenue with respect to y. So we are differentiating this function. First derivative of 60y with respect to y is 60. And first derivative of 0.0075 y squared with respect to y squared becomes 2y by the rules of differentiation. So it's 0.0075 times 2y. So that's 60 minus 0.0015 y. So in order to maximize profits, we set marginal revenue equals marginal cost, which means we set 20, which is the marginal cost, equals to the marginal revenue, which is 60 minus 0.0015 y, and we solve for y. So we get that y star, which is the solution for y, equals 26,667 units, which means that we need to sell 26,667 car days to maximize profits. Okay? Now we can also find out what is the price that we have to charge to maximize profits. We simply plug this into the estimated demand. Here we have a rearranged estimated demand. So we, instead of y, we put 26,667, and we solve for p. So p star comes to around $40, which means that our profit maximizing price is $40. So we know now that if given those cost and demand conditions, in order to maximize profits, we have to sell 26,667 car days and charge $40 per car day. So we can find out, and now of course we naturally ask, if we do that, what will be the level of our profits? Well, it's easy to calculate because profits are total revenues minus total costs. So total revenues are the price, the maximizing price times the maximizing quantity, 40 times 26,667. So we get 1,066,680 as our total revenue. Our total cost is the cost function 565,000 plus 20 times y, and y, the maximizing y is 26,667. So our cost level is 1,998,340. So the difference between the total revenues and total cost is a minus 31,660. So we maximize our profits at a loss of 31,660. But that's okay because profit maximization, well, it's not okay, but it mathematically and logically it makes sense here. It's not okay business-wise because what it says is that the best that we can do is to lose money. Except that instead of maximizing our profits, we minimize our losses. But loss minimization and profit maximization are two sides of the same coin. So in this case, given those demand and cost conditions, the best that we can do is minimize our losses at $31,660. So that's the profit maximizing model. Okay, you're familiar with this model because that's the central model in managerial economics. Except not everybody that teaches managerial economics tells you that while this model is conceptually attractive and mathematically flawless and gives you optimization, it is rarely, if ever, used in business. So why, if it is conceptually attractive and optimizing, why it's rarely, if ever, used in business? Why don't we all use it? On paper, theoretically, it seems to be preferable to the pricing models, the cost-plus model, and the target pricing or the target costing model that we saw before, that is much more commonly used. So why don't we use something that is theoretically much more attractive and gives us straightforward answers as to how do we optimize? Well, there is a reason. I mean, business people are not dumb. And this is not a terribly, conceptually, it's not a difficult model to understand, but it's not used for a reason, or mostly not used for a reason. Any ideas? Yes?
Because like you talked about too much information about like the market
Right.
and all the variables might not
Yeah, is because it's predicated mainly on the fact that you can get all this information, and particularly, absolutely right, and particularly that you can indeed in practice reliably estimate a demand function. And reliably estimating a demand function in practice is very, very difficult and often impossible. Why? Because, number one, a realistic demand function is not that simple functionally. It's not only quantity demanded as a function of price. There are many other factors that affect quantity demanded, such as the income of the customers, the substitutes, availability of substitutes, the quality of the product, and et cetera, et cetera. So if you want to specify a realistic demand function, it has to have more explanatory variable to explain why quantity demanded, not only price, but you have to have other variables. So you have to have a multivariable function, but that's not the main difficulty. The main difficulty is how you estimate that. Well, you said, was no problem. We estimate that statistically. Oh, we know how to run. Okay, so we have more than one variable. We have 10 variables that expand demand. So we have an equation with 10 explanatory variables. We're big boys and big girls. We know how to run multiple regressions, right? If we need to. Studied multiple regressions in statistics. So, well, yes, we know how to run multiple regressions, but the problem is to estimate multiple regression based on a specified demand function, you have to have the data. You have to have reliable data. Yeah, you can find data, but the question is, it has to be good data and reliable data, because garbage input, garbage output. So how do you get reliable data? Well, one answer is you get it on the basis of history. You go back historically and look at various price levels and income levels, and you look at the quantity demanded, and you get those historical observations, and you feed them in. Well, in this example, it's a new car location, so there is no history, right? So historical data is not going to be available. But let's assume it's an old car location. Historical data is available. How are you sure that whatever relationships existed in the past really still obtain to the period you're interested in? You have to make the assumption that whatever was valid in the past in terms of relationships between the variables is still valid now. That's a big assumption. If you don't want to use historical data, you have to use survey data. You have to do market research and get surveys of your customers, which is also very tricky and often not reliable. So in the end of it, most business people in most situations think that their chances of getting a reliable estimated demand function are very small. And if the demand function, and getting it is putting a lot of work into it, because you have to specify it, you have to collect the data, you have to estimate it, you have to analyze it, and on top of it, after you do all this work, you may not get accurate estimates, and therefore your optimization solution, if you don't get accurate estimates of the demand, could be grossly inaccurate. So this is why, in most cases, however theoretically attractive this optimization pricing model is, it's not used, and the cost plus and the target price, target costing methods are the ones that are used most of the time. Okay, any questions about pricing? Any questions about those models? So you can see, all in all, pricing is a very important decision, but having a good pricing model, satisfactory pricing model, is difficult. If we have a theoretically attractive model, then practically it's hard to find all the information, as you suggested, all the information that we need to estimate it accurately. And if we go to quick and dirty methods like cost plus pricing, we don't explicitly consider demand, and then we may target to point A, which is not sustainable by market demand. And then what often is done is you try to get to point A and produce and sell 30,000 car days at a price of 43, and you see that it's not sustainable, and you start doing trial and error to reach a more sustainable equilibrium. So pricing is, in the real world, is a murky process at best. But so it is. I mean, real world conditions are complex, and that's not a surprise. So reaching a pricing decision is not easy because, first of all, it requires reliable cost data, which means it requires reliable cost allocations. But even if we have reliable cost data, that's not sufficient. You have to have reliable demand data, which is much more difficult to get than the cost data. Okay? Let's get into another issue that is connected to prices, and that's differential prices. In many cases, it's warranted to price the same product, in this case car rentals, differently when demand conditions change. When demand conditions change. Then the relevant costs to price under different demand conditions may be different. Let's look at a typical example of variations in demand. Let's assume that the car rental, that location that we are talking about, is in a business area. It's close to industrial parks, which means that the main customers are the people in the who work in the industrial parks, the executives, and the business people who come to visit them. Those are the people who rent the cars. Now, obviously, if we're talking about this industrial demand or demand by business people, you would expect it to vary by days of the week. There'll be stronger demand during weekdays, which are working days. But in non-working days, such as weekends and holidays, there'll be much less demand by business because much of the business is not going to be working. And then you will expect that what will happen if you are in an industrial location and you build a a car fleet to rent and satisfy industrial demand. So what would you expect to happen on a weekend or a holiday? You would expect much less demand, and you would expect excess capacity. You will have a good number of cars sitting on your parking lots on weekends and on holidays idle because there are not enough customers. So let's assume that on weekends and holidays, statistics show that in your car rental location, 36 cars per weekend or holiday day on average are in excess capacity. That is, means they're sitting there as excess capacity, which means they're sitting there idle, they're not rented because of the lower demand on weekends and holidays. So the question is, what could you do? What could you do to increase your demand on weekends and holidays? Increase your demand by other customers than business customers who don't need to be there. Well, one way that you can do is you can change the circumstances because you're in an industrial location, but you could discount your prices to get the cars moving. You can discount them on those particular days. In other words, you could announce that you are selling cars at a discount, you're renting cars at a discount on weekends and holidays. Question is, how much of a discount, given the cost situation, how much of a discount you could give and still add to your profits? Well, the general answer to that is that you can charge, as long as you charge a price that more than covers your variable costs. Your variable costs, you will still be adding to your profits. Why? Because the fixed costs are there anyway, right? What are your fixed costs? Your fixed costs are the costs of leasing the building and the land, right? The $11 per car day. And another fixed cost is the opportunity cost of tying in the funds, which is $6 per car day. So you have $17 per car day, which are fixed costs. Well, those costs you're going to incur whether you rent the cars at a discount or not. So if you're going to incur those costs anyway, they are irrelevant for your discount decision. So as long as you price in a way that will more than cover your variable cost, you'll be adding to your profits. Let's assume that your variable costs, given these examples, well, we're saying they vary between 12 and 20, and I'll explain why in a moment. But let's assume that they're $20 per car day variable cost, which includes $10 depreciation, $2 maintenance is $12, and $8 selling and admin. So $20 per car day variable costs. If you discount your car rentals to a weekend or holiday price of $30 rather than $43, which is your regular price. Your regular price, let's assume, based on cost plus is $43, and your discount price is $30, you'll still be adding to profit, because if you rent a car day at 30, what will be your additional cost? Your additional cost will be 20, but you're going to earn a $30 per car day, so your incremental addition to profit is going to be 30 minus 20, or $10 per car day, because the fixed costs don't figure whether you rent at a discount or keep the car idle. You will incur them anyway, right? So the relevant costs for this decision are the relevant costs for those decisions, for this type of decision, discount decision on holidays and weekends, are the variable cost. Does this rationale make sense to everybody? Okay. Now let me explain two complicating factors here. One is, why do we say that the variable costs are not that easy to define, that they are not 20 or 12, but they vary between 12 and 20. The variable cost of renting more space for the weekend or the holidays. And the reason for that is that you have really three types of costs. You have the fixed costs. Well, if you see how costs, in this case, the costs of rental vary with respect to volume, the number of car days, y, and here we have costs. Fixed costs, of course, don't vary. So we have fixed costs. And these are the costs of the buildings, of the lease, and the opportunity costs. And you have the purely variable costs. The purely variable costs, which are the costs of maintenance and the cost of depreciation, they vary per each car day. So they'll look this way. This will be the function that is purely variable. But what about the $8 per car day selling and admin? They are the costs of maintaining, they're the costs of doing what? Of having, selling and admin people that rent the cars and do the accounting and so on. Now those costs are semi-variable. It's a step function. Why? Because for so many car days, you need one person to handle that. And then after you go, so the fixed costs are the costs of enumerating, compensation of one person. And after you get to some critical mass of car days, one person cannot handle that. So you have to add another person, right? So the costs jump. And then two people can handle so much volume of car days. And then you have to add a third person and a fourth person. So these are semi-variable costs. So if you just want to rent a few discounted car days on the weekends, you may not need more selling and administrative people, and therefore your variable costs are only the cost of depreciation and maintenance, which are $12. But if you can rent a lot of other cars at a discount price, many car days, then you may need an extra person. And then maybe the variable costs are $20. So you have to be careful. One thing is clear, you will always incur $12 variable costs, because they're purely variable costs. The purely variable costs are $2 maintenance per car day plus 10 depreciation. You'll incur those. So under no circumstances will you discount your prices to below $12, because if you discount your prices on weekends and holidays to below $12, what will happen? You'll be losing money, right? If you rent at 10 or at 9, say you rent at $9 per car day, and your variable costs are at the minimum 12, what will be the incremental loss? $3 per car day, so that doesn't pay. So if you can rent them only at 9, you're better off having them idle. Because if you have them idle, you don't incur the maintenance and the additional maintenance and depreciation costs. So now, the other complicating factor, in any analysis there are complicating factors, so things are not that simple. And that's a good thing, because things are not simple. They need cost managers like you who can make complicated decisions based on unique circumstances. If the decisions were simple and generally applicable, they could have smart computers making the decisions, right? Fortunately, that's not the case. So another complicating factor here is that when you sell car days at a discount on holidays or weekends, you have to make sure, say you charge $30 per car day, you have to make sure that you're selling it to a customer that would have not rented the car at the regular $43. That by the discount you're attracting customers that you wouldn't have otherwise. Because if you announce $30 discount on the weekends and holidays, and you get a customer that otherwise would have anyway needed a car and would rent it at 43, then you're not making money, because you're losing 43 minus 20 to gain 30 minus 20. Now, of course, in this example, it is likely that if you have competition of other car rental companies, it's likely that on the discounts on the weekends will leave a competitive price of 30, and therefore no customer, you're not going to get customers that would otherwise pay 43 because of the force of the competition. But in some cases, but if you don't have competition, that may not be clear. Another example you have in your case, the airline example, where the airline example is that it pays airlines to discount prices if the flight is already scheduled and it's not full. Because flying an extra passenger, the incremental costs are low. And the other costs of operating the plane would incur anyway if the plane is flying, right? So if you discount just to ticket level that only covers the incremental cost of flying additional passengers to fill in the space, then you'll be making additional profits. But only if you give those discounts to people who wouldn't have flown otherwise at the regular fare. So you have to figure out how you give the discounts to have reasonable assurance that you give them to people that otherwise wouldn't have flown in the regular fare. So there are various kinds of tricks. For example, you figure out that that on flights, business customers are less sensitive to fares because they need to be at certain places to do business. If they cannot do it by telecommunicating, they need to be certain places to do business. And they fly for short periods of time. So you don't want to give them discounts because they will fly anyway if they need to do business and pay the regular fare, right? The company will pay the regular fare. But if you're not flying full, you want to get other people that are not business people, maybe people who go on vacation and are more flexible in terms of the times. So you know that business people are going for short periods of time, mostly, and you know that vacationers are going for longer periods of time. So you can say, I'm going to give discounts only for people who return at least a week later or 10 days later, right? So I will sell the discount tickets, but the return will be at a discount only if you stay at the place that you go a week or 10 days, because then you capture the vacationers, right? So there are various kinds of tricks to try to capture different types of customers with different sensitivities to prices. And that's why differential pricing is used often, but has to be used with care so that you're sure that you're adding to your profits. But generally, when you consider discount prices because you have excess capacity, you have idle resources, then the fixed costs are not relevant. What is relevant are the variable costs. So you have costs that become irrelevant for these types of decisions. Another good example of differential prices is many electric utilities who have fixed capacity, who put in a capacity that is designed to handle peak demand. They have to handle peak demand because if they don't have enough capacity to handle peak demand in electricity, what will happen? There'll be brownouts or blackouts, right? But the peak demand is usually during day hours where industry and companies are working and so on. That's where there's peak demand. There's much less demand during evening hours. So there'll be a lot of unused capacity. Now, putting in more capacity to meet peak demand is expensive. You have to put all the electric grid together and so on to have enough supply of electricity. So what electrical companies are interested in doing, if they can, is to shift demand, some demand, to induce customers to shift some demand from peak hours to off-peak hours. So for example, if they can, and if the customers can do it, but they have to give customers an incentive to do it, and what is the incentive? The incentive is usually a price discount. So for example, they can figure that we have discretion, we as residential customers have discretion as to when we do our laundry, just as an example, when we activate our washing machines. So they may issue a discount and saying rates after 9 o'clock or 8 o'clock in the evening, electricity rates are lower, so that you will be induced to use your washing machine at 9, 10 in the evening, where there is excess capacity, and as long as they cover their incremental cost, they'll be still making money. And they will induce you to shift demand from peak so that they don't have to construct or put in more capacity at peak. So that's another example of differential pricing, where the relevant costs are the incremental costs when there is excess capacity and avoiding the costs of putting in extra capacity. Okay. Finally, let's talk about another type of decision, which is a phase-out decision. Remember, we had an example where we used in our example the optimal pricing, the optimal economic pricing, and the optimal pricing showed us that if we charge the profit maximizing price and we sell the profit maximizing number of car days, we'll still be losing money, about $30,000, a little bit over $30,000. So then the question may be, well, if that's the case, maybe we should phase out. Maybe we should, in this case, maybe we should eliminate this car rental location because under the best of circumstances, it will be losing money. But if you want to consider phasing out, you have to undergo careful cost analysis. And the cost classification that is relevant here is to decide if you phase out, if you close down this location, what are the costs that are avoidable by closing down, phasing out, and what are the costs that are unavoidable. In other words, there will be costs that if you close down the location, you'll save them. You'll avoid them. But there will be costs that you will not avoid. Now, in case of our example, which costs are you not going to avoid? Let's assume that for 2013, you figure out that the best you can do is to lose $30,000. But let's assume that your leases expire only at the end of 2013. So if you close at the beginning of 2013, you cannot avoid the leases, paying the leases for the building and the land until those leases expire at the end of 2013. So $385,000 in our example of the costs of leasing the building and the land will be unavoidable. So given this example and given the optimization model, should you close down or phase out in 2013? What's the right decision? Well, I suggest to you that you shouldn't, because you have to recalculate the model. If you solve the optimization model on how much profit you can make under the best of circumstances, but now you solve it under the scenario of under the scenario of examining the decision of phasing out, what cost is irrelevant? The unavoidable costs. So you shouldn't include the $385,000. If you don't include the $385,000 and you solve for the profit maximization, you'll find out that you'll be making money. Just subtract the fixed cost of $385,000 from your total cost and redo analysis. And I assure you that you'll find that you'll be making a hefty profit. Why do you have to take out the 385,000? Because you'll incur it anyway. Because you are bound by contract to pay the 385,000 until the end of the year. So it is an unavoidable cost, and therefore it's irrelevant to the type of decision that you're making, which is a decision of whether to phase out in 2013 or not. Now, at 2014, it's a different decision, because at 2014, your lease expired, and the 385,000 are avoidable now. How are they avoidable? You don't have to sign a new lease. Nobody's going to force you to sign a new lease, right? So those costs are avoidable, and therefore they are relevant. And you may find out that at 2014 it's a good idea to phase out. But it's not a good idea to phase out 2013. If you'd phase out 2013, you'd lose money. So it's very important. It's very important to make those decisions. Now you have to examine your contract carefully, because in many contracts the provisions are the contract expires for the building and the land expires at 2013. But you can get out of the contract if you pay a penalty. And let's assume that the penalty is $200,000. Then what is the unavoidable cost? The unavoidable cost is not anymore $385,000, but the unavoidable cost is $200,000, because you can get out of the contract just with a penalty of $200,000. So you have to do the analysis by taking out only $200,000. You'll still find, under these set of circumstances, that it still pays to continue to operate until the end of 2013. So you can see that it's very important to classify the costs to make the right decisions and to decide which costs are relevant or not. In this case, it's important to identify the non-avoidable costs of $385,000, or if the penalties are $250,000, just of $250,000, and not include it in the decision, to realize that the cost is irrelevant. Now, another idea is what happens if you add a location? Well, you add the location in stages. You add a new location. You have to prepare for the lease of the building of the land. So at some point you sign for the leases. Let's assume that you thought that it's attractive operationally to open the location, and then you get new operational data about demand, which is much more grim and makes you reassess that it's not worthwhile to add this location. Well, it depends when you get the new data. If you get the new data before you sign the leases on the building of the land, then the cost of the leases are avoidable, because if you didn't sign, then you can just decide not to sign, and you can avoid those costs. But if you get the new information, grim information about demand, after you sign the leases, then the cost of the leases is unavoidable. And you have to consider it irrelevant when you make a decision whether to add the location or not. So, any questions about avoidable and unavoidable costs. Well, there are a good number of other decisions to important business decisions to analyze, and we'll continue our discussion next Tuesday. But again, I remind you that our priority next Tuesday, before we continue our discussion on these subjects, our priority is to entertain any and all questions that you may have about the assignments or the materials, so don't hesitate to bring them in. Okay, thank you. Have a good weekend. See you on Tuesday.